Hi guys, welcome back to my YouTube channel. Today we're talking all about capital allowances, what they are, how you need to know about them, and basically why they matter to you. But first, before we get stuck into things, please do make sure you give this video a big fat thumbs up so YouTube knows this is truly the good stuff. And also, everyone here is probably following me, but if you're not already, please make sure you do hit that follow button so you do not miss out on any more absolutely fantastic tax saving content. Okay, so capital allowances, what are they? So when you buy assets for your business, so assets, these are things that go on the balance sheet. So usually you've got your revenue expenses and your capital expenses. Revenue expenses are what you incur in order to earn money. So they're going to be recognised in your profit and loss. But assets, they go on your balance sheet and they sit as an asset and they basically get depreciated. And depreciation is where you recognise the cost of the asset over its useful life. So if you were to buy an asset for £1,000 and you expect it to last 3 years, you would probably depreciate that at 33% each year, which means when you first buy that asset, you'd have a £1,000 asset on your balance sheet, and at the end of that, you'd effectively recognise that you've used 33% of that asset because it's going to last 3 years. So a third of that would be recognised in your profit and loss, and then the balance on the balance sheet would also be reduced accordingly. So that's the accounting jargon of it. As you can see, it's a little bit complicated, but the main thing here really is that it's all about assets. Assets going on your balance sheet, and it's assets what qualify for capital allowances. So capital allowances are basically the taxman's way of giving you some tax relief when you spend money on assets. Because, as we mentioned that depreciation word a moment ago, depreciation is not allowable for tax purposes. It gets added back on to the costs, added back onto your taxable profits, which means you don't get any tax relief. So with capital allowances, the way they work is in a number of different ways. You've got your first year allowances, which are available on certain eco plant and machinery, certain electric cars. You've also got your 100% annual investment allowance, and what this means is where you get 100% of the cost of the asset you can claim in the year that you spend the money against your profits. So say for instance you have got £100,000 worth of profits. You spend £50,000 on qualifying machinery, which qualifies for the AIA. You can claim 100% of that, which now brings your profits for tax purposes down to just £50,000. So as you can see, they're very valuable from a tax perspective because they're going to help you pay less tax. You need to make sure you're claiming them. For assets that don't qualify for the annual investment allowance, you can claim the standard write down allowance in the general pool, which applies to most machinery. This is 18%. Or for items that go in the special rate, it's just 6%. But where possible, you always want to be trying to claim the AIA because you're going to save the most amount of tax. So a question I get asked all the time is, do I have to claim all of my capital allowances? And the answer is no. So with capital allowances, you can claim as much or as little as what you want. So if you had £50,000 worth of potentially claimable capital allowances, but you only wanted to claim 20, you have the flexibility to claim as much or as little as you want. And also, capital allowances for tax purposes apply to sole traders, partnerships, LLPs, limited companies. Broadly, they work in similar ways no matter what your business structure is. So make sure that you are working with your accountant, you're fully aware of capital allowances, and you're thinking in your head, if you brought this new iPhone, which qualify for 100% AIA, laptops, furniture, all of this kind of stuff, make sure you're getting your tax relief on it, because at the end of the day, when it comes to getting your tax bill and it's higher than you expected, you now know to make sure that your account is claiming AIA because it's going to save you tax. So a fantastic tip for property investors is if you're using your property for a qualifying business such as serviced accommodation and you own the property outright, you can actually claim capital allowances on the value of the fixtures inside the property. You need a capital allowances surveyor to do that. Message me, we can help get one set up. Usually it can be anywhere from 10 to 30% of the property value in actual capital allowances. So for some serviced accommodation operators, they don't pay tax for many years after buying the property because they've used capital allowances to their full potential. It's complicated stuff, so speak to a professional. We can't run through it all in today's short YouTube video. But that really is all for today. I hope you found this short video useful. As always, we're straight to the point, no beating around the bush, but make sure you've given this video a big fat thumbs up and you subscribe for more tax saving content. Bye for now.